As most of you are probably aware, Congress passed and the President signed into law legislation that's going to overhaul the U.S. healthcare system. And it's actually two pieces of legislation. One is the Patient Protection and Affordable Care Act of 2000 and signed in March 23rd, and the other one was the Reconciliation Act that was signed in March 30th, 2010. And you've heard a lot about it. It's a massive overhaul. When we get handouts, we get information from our tax services. This is what it looks like, and this includes not only to try to explain it, what the changes are in the code, what the reports were that are coming out of the various committees on how it's to be interpreted. But it's a massive, we've heard a lot about it, it's a massive host of changes. Taxes have a lot to do with this legislation. Now, so we're going to go through a couple concepts, try to get into some of the particulars that are going to help. Its purpose is to provide adequate health insurance coverage for everyone in the country. And through insurance that they would hope that everyone's going to have a primary doctor, that you're not going to have to go to an emergency room anymore. They're going to make sure that one of the key things is to make sure the insurance is affordable, and that it will greatly expand who's covered and actually what is covered. So these are some of the scope or some of the intent of what's going on. But obviously, expansion comes at a cost. And that cost is going to be carried by the many new and different novel tax changes that are going to have to take place. When we talk about healthcare, we have to talk about the IRS. And let's talk briefly about the IRS. You can see we process 230 million tax returns. They give 127 million refunds. By the way, if you're getting a refund, make sure you come talk to us, because we want to make sure that they don't have your money any longer than they should, but that's a different issue. They get 68 million phone calls. They got a tax code that's over 71,000 pages at this point in time. They got countless audits, and by the way, there are a lot more audits taking place right now. And they give out all kinds of tax notices, and now they actually get to enforce tax health care. This bill gets phased in over a long number of years. The last provision actually takes place in 2018. So we're now in 2010 through 2018. It's about a 7-year period that we're going to phase some things in. Individuals are required to get health care insurance. Employers are not required to provide the health care insurance. However, except for large employers. And large employers are employers that have 50 or more employees, all right? You're going to be subject to what's called a pay or play rule, all right? So there's potentially penalties if you're deemed to be large. It begins after 2013, so we're talking 2014 at this point in time. Larger employees, they have to offer coverage for all full-time employees, offer minimum coverage that's unaffordable, and make sure that it's not unaffordable, I should say. Offer minimum coverage in which the total allowed costs or benefits are not less than 60%. If you don't do those type of things, you're going to be subject to a penalty. So even though it's deemed that individuals have to do it, companies are required if they're 50 or more. Full-time is deemed to be 30 hours a week, and so that's a key concept. The penalty, for people that you don't provide adequate insurance, is $2,000 a year, but you pay it monthly. Even if you do offer coverage, you may be subject to a penalty if it's unaffordable, because I went through earlier that if it's over a certain percentage of household income or doesn't pay at least 60% of costs, and the employee's under the federal 400%, remember 400% of the federal poverty level, then there's actually a penalty if they opt out of your plan. So this is different. So the first one is you owe a penalty if the insurance is not adequate in terms of what it is. This one is if they decide to opt out, you owe a penalty because they're going to opt out and actually go to an insurance exchange. So in effect, you'll be helping to pay for the insurance exchange. That penalty is $3,000 per year, again calculated monthly. We have an example here where there's 100 full-time employees and 20 receive a tax credit for enrolling outside the exchange. That's what I'm talking about, opting out of the plan into the health insurance exchange. Then you would owe 20 times $3,000 would be a penalty of $60,000. But the good news is you only have to pay the lesser of the two penalties. So in this case, because you had people that opted out of the plan, okay, you have to pay the $3,000 for those who opt out. But because your plan failed to meet some of the minimum requirements, you have to take a look at the total people in the plan, 100, You get the first 30 for free, so it'd be 70. So the maximum, the penalties that calculate are 70 times 2,000 is 140, or for the 20 who opted out, you owe $3,000 penalty. So you pay the lesser of the two penalties. In this case, the opt-out is only $60,000 as opposed to $140,000. This is one of the provisions that the IRS has wanted to put in for years and years and years. If you're in business, you're aware that you have to issue what's called a 1099 miscellaneous anytime you pay an individual more than $600 for services. You've never had to issue it if a corporation provided those services. Starting after 2011, 1099s have to be issued to corporations, not just individuals or partnerships or LLCs. If you look at this provision, because we had just gone through minimum coverage, who you're paying for, the amount you're paying, employers are going to have to report to the IRS information on minimum coverage, dates of coverage, whether who's covered, qualified plan, any other information that they deem they're going to need in order to calculate those penalties. So that reporting is coming down the road. This is going to be kind of interesting. If you think through this, I don't know how, it's going to be rather difficult to do, but they have to have it in order to see if there's any kind of excise penalties. By the way, one of the things that's near and dear to my heart is conversions into Roth IRAs. So anyone who wants to talk about it after the seminar, I'll be happy to stay around as long as possible to go through that with you. But the Roth IRAs are good things. Now, what can we do? You know, I'm a tax guy, so I figured I might as well end with a little bit of tax planning ideas in terms of what you can do. What's most important, I think, I mentioned it before, is I think you really have to get your team together to kind of plan for this as you move forward. And the way I look at it is 3 different people really are important to be part of your plan. It's got to be, I think, your HR person, so you can understand your employees' number that you have, work through full-time equivalents. It has to be your insurance carrier, whether you're working directly with the insurance carrier or with a broker, to better understand what your health insurance coverage is, what you're required to provide, what the costs are, things like that. And also with your CPA in terms of how it's going to affect you from a tax standpoint, whether it's taxes you have to pay or excise taxes that you're going to have to pay. Thank you for coming out on this nice day. There's a number of people here from Gunnup that will be happy to talk to you. I appreciate you getting your day started off with such a great subject and great topic, get you ready to go at this point in time. So thank you very much for coming out.